Why TLT will outperform stocks next year. Why the Fed pivot will be worse than you might think. I believe the conditions now favor an imminent stock market crash. Long bond like TLT will outperform stocks next year. What does the Fed pivot mean right now? Does it mean the Fed will lower the rates back down because inflation is cooling off? Yes, that's the most reasonable explanation. If we saw the inflation trend staying flat at 5% for a long time, will the Fed pivot? Probably not. If we saw the inflation trend cooling down dramatically, like getting close to 2%, that would be fantastic news, right? Markets will most likely rally, right? Not so fast. I will explain it all right after this. And of course, smash the like button. If you want to be my good boy, apply to write your first book with me. Welcome back to the Audacious Money Witch channel, where we talk about macroeconomy, stocks, bonds, and commodity markets. If you like any of these topics, you are intelligent. That's why you're here, and you know what to do. And push my button if you like what you see in today's video, because I can't push it from this side. This video is brought to you by my Patreon. If you are a good boy, go to patreon.com/magicalgoddesscheryl to add more meaning into your life. If you play your cards right and completely submit like my good boys do, then I will take you under my wing, author of best-selling books, Goddess Cheryl. My good boys always get rewarded handsomely. You are such a good boy. You like hearing that, don't you? You want to get it into the bookstore. You want it to be real. You want it to be true. You need to be my client, don't you? First, I believe conditions are everything. Conditions dictate probabilities. Probabilities dictate outcome. Risk on, risk off is not about direction in stocks, but rather conditions that favor lower or higher stock market volatility ahead. Risk off is about the conditions that favor an accident. Conditions are quantifiable based on historically proven leading indicators. 2022 is investors' hell. Why? Because in my world, treasuries based on history are the beneficiary of heightened stock market volatility during risk-off periods. Treasuries instead became the source of volatility. This is the only year in history where treasuries have lost more than stocks in a top 20 drawdown for stocks. The signals that go into my rules-based approach were right. The expression of risk-off treasuries was not. What are the primary signals I track? Lumber relative to gold because of the link to housing. Utilities relative to the S&P 500 because of the link to bonds. Treasuries themselves, yes. Treasuries are not just a signal of risk-off conditions for stocks, but also a way of benefiting from it historically, except this year. I've been noting that since November 16th, something changed. Following the FTX collapse, treasuries notably were acting differently in their behavior against stocks. Yes, part of this is on hopes of peak inflation, but intraday interaction clearly started changing then. The internal note of intermarket relationships is changing. Lumber relative to gold keeps hitting new lows, and utilities relative to stocks were resuming their advance. So what, you might ask? Historically, every major stock market crash has been preceded by weakness in lumber relative to gold due to housing and strength in utilities. Both are confirming conditions now. This period reminds me of the 2011 summer crash. Defensive sectors led for a long time. And historically, when lumber has been this weak for this long, a major decline in stocks occurred. But why now? What's the catalyst? There's a non-zero probability that the FTX collapse has a delayed spillover to stocks. A margin call in one asset class is never just isolated to one asset class. Stocks collapsed a week after Lehman filed for bankruptcy in 2008. My point is that there are legs and that markets have a funny way of surprising the crowd out of nowhere. It is not impossible to see a scenario where the butterfly creates the hurricane. And treasuries are clearly agreeing here despite strong unemployment data. Something is bothering treasuries, utilities, and lumber. Given positive seasonality and an expected slowdown in interest rate hikes, they should be signaling risk on. They aren't. I believe we could see a move in treasuries like November, December 2008 now. The Phoenix Rising idea isn't about treasuries making money. It's about the return of the flight to safety trade that has been missing all year. People underestimate just how dramatically treasuries can outperform stocks in real risk off. I don't. Bear markets make fools of bulls and bears. Opportunity always exists when the crowd thinks it knows an unknowable future. Remember, there are no gurus, only cycles, and cycle of risk-off conditions are here. The Federal Reserve does not create a downturn due to rate hikes. It creates the foundations of a crisis by unnecessarily lowering rates to negative territory and aggressively increasing its balance sheet. It is the malinvestment and excessive risk-taking fueled by cheap money that led to a recession. Those economists probably saw no risk in negative rates and massive money printing. It is profoundly concerning to see that experts who remained quiet as the world accumulated $17 trillion in negative yielding bonds and central banks' balance sheets soared to more than $20 trillion, now complain that rate hikes may create a debt crisis. The debt crisis, like all market imbalances, was created when central banks led investors to believe that a negative yielding bond was a worthwhile investment because the price would rise and compensate for the loss of yield. A good old bubble. Multiple expansion has been an easy investment thesis. Earning downgrades? No problem. Macro weakness? Who cares? Valuation soared simply because the quantity of money was rising faster than nominal GDP. Printing money made investing in the most aggressive stocks and the riskiest bonds the most lucrative alternative. And that, my friends, is massive asset inflation. The Keynesian crowd repeated that this time would be different, and consistently larger quantitative easing programs would not create inflation because it did not happen in the past. And it happened. Inflation was already evident in assets all over the investment spectrum, but no one seemed to care. It was also evident in non-replicable goods and services. Now many market participants want the Fed to pivot and stop hiking rates. Why? Because many want the easy multiple expansion carry trade back. The fact that investors see a Fed pivot as the main reason to buy tells you what an immensely perverse incentive monetary policy is and how poor the macro and earnings outlook are. Earnings estimates have been falling for 2022 and 2023 all year. The latest S&P 500 earnings growth estimates published by Morgan Stanley show a modest 8 and 7% rise for this and next year respectively. Not bad. The pace for downgrades has not stopped, and the market is not even adjusting earnings to the downgrade in macroeconomic estimates. When I look at the details of these expectations, I am amazed to see widespread margin growth in 2023 and a backdrop of rising sales and low inflation. Excessively optimistic? I think so. Few of us seem to realize a Fed pivot is a bad idea. And in any case, it will not be enough to drive markets to a bull run again, because inflationary pressures are stickier than what consensus would want. I find it an exercise in wishful thinking to read so many predictions of a rapid return to 2% inflation. Even less when history shows that once inflation rises above 5%, in developed economies, it takes at least a decade to bring it down to 2%, according to Douchebank. Even the OECD expects persistent inflation in 2023 against a backdrop of weakening growth. Stagflation? That is the risk ahead, and a Fed pivot would do nothing to bring markets higher in that scenario. Stagflation periods have proven to be extremely poor for stocks and bonds. Even worse when governments are unwilling to cut deficit spending, because the crowding out of the private sectors works against a rapid recovery. Current inflation expectations suggest the Fed will pivot in the first quarter of 2023. That is an awfully long time in the investment world if you want to bet on a V-shaped market recovery. Even worse, that pivot expectation is based on a surprisingly accelerated reduction in inflation. To cut inflation drastically, 3 things need to happen, and only one is not enough. Number 1, hike rates. Number 2, reduce the balance sheet of central banks meaningfully. Number 3, stop deficit spending. This is unlikely to happen anytime soon. Investors that see the Fed as too hawkish look at money supply growth and how it is falling, but they do not look at broad money accumulation and the insanity of the size of central banks' balance sheets that have barely moved in local currency. By looking at money supply growth as a variable of tightness in monetary policy, they may make the mistake of believing that the tightening cycle is over too soon. Investors should not care whether the Fed pivots or not if they analyze investment opportunities based on fundamentals and not on monetary laughing gas. Betting on a Fed pivot by adding risk to cyclical and extremely risky assets may be an extremely dangerous position, even if the Fed does revert its pace, because it would be ignoring the economic cycle and the earnings reality. Central banks do not print growth. Governments do not boost productivity. However, both perpetuate inflation and have an incentive to increase debt. Adding these facts to our investment analysis may not guarantee high returns, but it will prevent enormous losses. And now I'm going to show you my client Lee Vincent's book, The 3 Most Important Influencers You Need to Meet. I did write the foreword in this book for her. Such an awesome book. And my client Teddy Eazzy's book, Wicked Pussy Perfume. It is an erotic novel. Such an awesome book. And my book, Rainbow Focus. This one is available actually in the bookstore. So Barnes & Noble and Indigo. This one. You are such a good boy for watching my video right till the end. Bye.